Welcome to our guide on managing property, plant and equipment or PPE in the public sector. We'll explore Ipsas 17, a rulebook for accounting long-term assets in a clear, consistent way. This builds public trust by making financial health understandable. Ipsas 17 guides public entities on handling tangible assets like buildings, roads, and machinery. It ensures financial statements reflect true asset investment, aiding in resource decisions and accountability. By the end, you'll grasp essential principles to master Ipsas 17 for your organization's assets. To record an asset, it must meet two Ipsas 17 conditions: future benefits and measurable cost. For example, a school bus aids student transport, fulfilling service potential. Once recognized, record the asset at its cost, including purchase price and necessary expenses. Consider a city buying a garbage truck for $150,000, plus $2,000 delivery and $3,000 for branding. Total cost, $155,000, entered into accounting records. Journal entry: debit PPE for $155,000, credit cash for $155,000. This places the truck on the city's books as a valuable asset. After purchase, distinguish between capital expenditures and maintenance expenses. Capital expenditures improve the asset, extending its life or service capacity. For example, a new engine for a bus is capitalized, enhancing future benefits. Routine maintenance, like oil changes, is expensed. Depreciation allocates asset cost over its useful life, reflecting wear and tear. For a $155,000 truck with a 10-year life, annual depreciation is $15,500. Journal entry: debit depreciation expense, credit accumulated depreciation. Ipsas 17 offers two valuation models, cost and revaluation. The cost model is simple, reducing asset value by depreciation. The revaluation model adjusts to fair market value, used for assets like land. Revaluation gains go to equity, losses are expenses. Impairment occurs when an asset's value drops suddenly, requiring a write-down. Journal entry: debit impairment loss, credit asset or accumulated impairment. Recognition removes an asset from financial statements when sold or scrapped. Calculate gain or loss by comparing cash received with the asset's carrying amount. For a truck with a $31,000 book value sold for $35,000, gain is $4,000. Journal entry: debit cash, debit accumulated depreciation, credit PPE, credit gain on disposal. If sold for $25,000, loss is $6,000. Adjust journal entry to reflect the loss. Let's recap Ipsas 17 for managing public sector assets. Recognize assets with future potential and measurable cost. Initial measurement includes purchase price and direct costs. Capitalize improvements, expense maintenance, and account for depreciation. Choose between cost and revaluation models. Watch for impairment. Derecognize assets upon disposal, calculating gain or loss for transparency and accountability.